TTF, NBP and the German power market saw a strong decline last week, and now the question is what is gonna happen with the new contract at the start of December. We also see that the EUAs are pushing towards new highs, so here the question is what's going on here. Hello everyone, my name is Marcello Colax, I am the Managing Director at Clever Markets, and today I'm gonna walk you through the charts for the week starting 1st of December 2025. Let's have a look at the front page of our dashboard. Here we are seeing that the TTF NBP are still bearish on the hourly chart, and we are closely tracking the intraday descending channels to see if we do get a bounce or if we just simply continue lower at the start of this week. German power is now neutral across all three time frames, which makes us very sensitive to any news that might be breaking that could move the market into a decisive direction, and we see that the EUAs are just bullish all across the time frames. And here are the results of the sentiment benchmark. You can see that it hasn't really changed from one week to another. And you can see the bulls and the bears are still equally represented week on week. There only have been minor changes. So overall it is still looking very mixed to us. And what that means for the TTF chart, we'll have a look at now. So let's get started on the TTF front month. So on the weekly chart we finally see some movement. We have broken past this range that has been putting the market in a sideways trend since forever, since August 2025. So you can see we got two very strong bearish red candles, and now the question is this just a correction? Are we moving lower? What's going on? So in order to answer this question, we are looking at a few things. We are looking at the trend tools, which are still pointing lower. So we have the 8 and 12 exponential moving averages that are both pointing lower, which means bearish continuation. Then we want to see, okay, so the market is going lower, but how strongly is it going lower? For that, I'm looking at the MACD, the moving average convergence divergence, and we just saw a tiny break of the MACD pushing below its trigger level or its signal line, which is ultimately a bearish signal overall. Then I always keep an eye on the stochastic. I want to just avoid that we don't get any bullish signals with moving out of oversold territory. So for now, nothing is happening here. Please do not take the move into oversold territory as a bullish reversal signal. It simply means that we are making new troughs. So here overall it's looking all fairly bearish to me. So, but this bearishness is best traded on the daily and hourly chart. So have a look here. I want to zoom out and I want to show you one thing. So you can see we had this descending triangle going on for the longest time, which has now broken lower, and we do get the descending triangle target somewhere in the 23-24 area. So we're still very far away from there, so this is not super relevant right now. So let's zoom in. Last week ended with just red all across. We also saw that the volume was going lower, but hey, this is completely normal towards the end of a contract, so don't take this decline in volume necessarily as a sign of bearish exhaustion. It simply means that traders are closing out, they're moving on to the next contract, so I wouldn't really take this as a sign of bearish exhaustion. Overall, we are still firmly bearish. Why? We are bearish because the 8 and 12 exponential moving averages, they did something called a death cross, and a death cross is when the faster 8 exponential moving average is going below the slower 12 exponential moving average, but both are already going down. So this simply means the market is going down, but right now it's going down even further, so it is a downtrend acceleration essentially. The MACD is simply bearish, so we are well below the zero line, we are making lows and lower highs, so nothing new here. Bearishness is continuing. And then I always keep an eye on the stochastic, and I want to see that the stochastic remains in oversold territory for now, because that would simply reaffirm bearishness. Now let's just look ahead for a little bit. If at some point in time we start seeing on the daily chart maybe a bullish reversal candle coupled with a move above the oversold levels, then we might get ready for a bounce, but for now I don't really see it happening. There could be more losses ahead. So on the hourly chart, we are now working with a descending channel. So you can see it's not the big thing here, it is more just this year with the channel going back to the 24th of November, because the market has been respecting this for quite some time. So last week we did get a bullish pattern, which was this here. So this here is a falling wedge, and falling wedges are usually resolved to the upside because it is showing us that the down legs are getting shorter and shorter, which eventually leads to a bullish move. Then last Friday we saw a break above this. The bulls couldn't hold on to their gains because this was a really good bullish trigger, but nothing really happened and we moved lower again. So what did we do? We drew in a descending channel, and now this seems to be holding quite nicely. So we ended last week with a very high volume session, a red bearish candle, but here's the thing, really high volume on a Friday during the last hour of trading at the end of a contract is not necessarily a bearish continuation signal. It simply means people are closing out. Okay, so we are seeing a flow of higher highs and higher lows on the momentum, while the price is making lower lows and lower highs. So this is called bullish divergence, and usually a sign for the market to eventually to push higher. But here's the thing, we ended last Friday with a bearish crossover, so I'm not 100% convinced. How I am reading this is like this. From the 24th of November, we saw that the down leg has gotten shorter and shorter, which then triggered the bullish divergence on the MACD, showing us that the bears are no longer in charge. They are not convinced anymore. But with the false break higher and the bulls couldn't hold on to their gains, we are then updating this to a descending channel. Of course, we can't change the history here anymore. So this is just a reflection of the downtrend not being very strong during the first half of last week. But I do think that even with a little bounce, as long as we remain within the descending channel, the bears still have a good chance at eventually continuing lower. That is also reflected in the still bearish stochastic, the firmly bearish 8 and 12 exponential moving averages as well. So bounce or no bounce, the bears are more likely to continue. Maybe we even see a little bit of a sideways range at the start of the session, with the market not really being sure what's up. Alright, now let's move over to the German power front year. So here on the weekly chart, we are observing this big head and shoulders pattern that hasn't really worked out for quite some time. So let's talk about this. So a head and shoulders pattern is usually leading towards a bearish reversal because we are seeing that the market is no longer making higher peaks, right? We see that the peaks are leveling off here and the troughs remain the same. This here is called the neckline, and a move below the neckline at 80 would put the bears firmly in charge. We haven't seen that yet, and with this rise that has been going on since July, this is no longer just a simple head and shoulders pattern. This is a complex head and shoulders pattern with a really weird right shoulder. So what's going on here? I say that a move above 94 would invalidate any hopes of eventual bearish continuation, because then we are no longer making lower peaks. This is not happening right now. I'm just warning you. It's also like the alternative to even touch this. More likely for now is bearish continuation. Why is that? That's because we did get a bearish signal on the stochastic. Yes, we didn't move into overbought territory and got a bearish trigger here with the move into neutral territory. But sometimes I like to take this, and you will not see this in any textbooks. It's just the Clever Markets methodology. If we are still close enough at overbought territory, we are no longer making new highs, we are making new lows, then this I take as a bearish signal. So this here, now the question is this a hammer? Is this a hanging man? Because we are at the top of the market, maybe this could be a hanging man, right? Or is this just the end of the downside mini correction and this is a bullish hammer? So is it a bullish or a bearish candle? Doesn't really matter. It's a red herring. We don't need to know. The only important thing right now in terms of classification is a daily or a weekly close below 86.05 would simply continue the downtrend towards 80. And at this point, it doesn't really matter how we classify this candle pattern. And then of course, a move above 90 would lead to 94. So let's have a look at the momentum, because I want to show you something. Overall, we shouldn't really make use of trend and momentum tools in a sideways market. And you can see how fraught this is, right? We are getting maybe like a bearish signal here and a strongly bearish signal here, bullish signal, maybe almost a bearish signal, strongly bearish signal, bullish signal. What is this? Bullish signal, bearish, bullish, right? So while the market, we are getting all these fun signals while the market is going nowhere. So here's one more general purpose rule. Do not use trend and momentum tools in a sideways market, especially in the German markets. It has been going nowhere. So now the next bit here is for everyone everyone here who is still relying on strong fundamental models. They are good and they do derive some edge, but sometimes they fall flat in a sideways market. And sometimes you don't know how long the sideways markets are continuing. For this year has been going on for ages. Since June 24, we haven't seen a good trend going on. So instead of fine-tuning your fundamental models to maybe squeeze a little bit of P&L out of something that the market isn't even reacting to anymore, rather start implementing technical analysis to combine it, not replace, combine it with your existing fundamentals to start building strong systems. And how to combine the two I will show you in our free Hybrid Trader playbook. I'll teach you a mini skill on how to combine technical with fundamental analysis in this free mini masterclass. It is completely free of charge and it's just my way to saying thank you to the industry that has been supporting Clever Markets so much over the years. So pre-registration is now open, so reserve yourself a seat. We will release this in January 2026 and I want to give my viewers first dibs on this industry first course. I have to be completely honest, I haven't seen this anywhere else. We've been working tirelessly to make this happen. So scan the QR code or look into the description below. So now let's get back to the German Power Front year daily chart. So here you can see we have been working with this ascending channel for quite some time and we have tested the upper end of this channel twice, which then resulted in this double top candle pattern. And here once again the bulls tried and we moved lower, and the bulls tried again and we found initial support here near 87.76, which is the neckline of this resulting double top pattern. We have now moved lower and we generated a downside target of this double top near 84.83, which coincides with the channel support. So there's a good chance for the market to eventually move here. But this might not happen immediately. So you can see even in our preferred case, we do expect the market to maybe move up a little bit, but as long as we find resistance in the 88.86, which is the 61.8% fib retracement, as long as we top out here, the bears could still continue lower eventually. And you can see here very nicely, this would then still mean a flow of lower lows and lower highs. Only a break above 88.86 would invalidate this bearish setup, and then probably a prolonged sideways market would simply continue. I don't really predict any upside continuation or upside acceleration for now. We can see that the bullish momentum is gone, the bulls are exhausted. Yes, we do expect a little bounce on the stochastic, but eventually the bears should continue. So this is one little trick, combining trend and momentum tools with oscillators to see if the up leg is just a correction in an underlying downtrend or if it is like a full-on trend reversal. Right now it looks like an upside correction in an underlying downtrend. But this is best traded on the hourly chart. Can you see here we have been working with this descending channel. It was quite reliable and last Friday we gapped higher, but the bulls didn't really manage to make anything of it and we started to push sideways. We still believe that the bulls could continue above 87.75 early this week to simply continue also the daily chart's corrective up leg. Only a move below 87.16 would then lead very quickly towards 85.95, and the bullish setup on the daily chart would also be undone. And now let's have a look at the EUAs. That's the last market we are looking at for today. So here on the weekly chart we have been within the ascending channel since February 2024, and you can see we have had some good border hits here and it kind of looks like we are making our way higher once more. Okay, so what is happening here? We had like a really good strong week and any hints of like strong bearishness are undone. The market is out of this slump here and we are simply continuing higher. This bullishness is reflected in the rising MACD, so the momentum tools. We have rising 8 and 12 exponential moving averages as well, and of course we have high volume. Now here's the thing, the contract will roll very soon, so it is completely normal that we are seeing higher volume with people closing out, going to the next contract, so it's all very normal. Now this bullishness is once again not traded on the weekly chart. We always have to go to a lower level time frame like the weekly, hourly, 15 minutes, and here we see that our rising wedge that has been signaling a decline in bullish interest is now broken to the upside. So the uptrend is accelerating once more. Now the question is, what is happening? Is this a really serious break or what's going on here? So first of all, we start seeing that we did get another bullish signal on the MACD. I don't like these signals, the crossovers between the MACD and the signal line, because hey, if we take this bullish signal, that also means we have to take this bearish signal, bullish signal, bearish signal, bullish, bearish. So there's too many. But sometimes when they are so steep and so far apart, then it's a little bit more reliable in terms of like being like a really break from a range market, which is the case here. We still think that we could make it past 83.4 and eventually towards 84.44, but up here we really need to see what's going on, because that is the peak that was last hit in January 2025, and as you can see, zooming back, it was this was then the highest price. Past this, we would then start aiming for the peaks from November 2023. So we still have quite a way to go if we really break past the 84.44. So for us, maybe eventual downside continuation, nothing too crazy. We don't have a really strong opinion about it. We only know that the market is more likely to push higher, and then we will see. So in our case, so in this case, scenario 1 and scenario 2 does not mean that 1 is the preference and 2 is the alternative. I think they're equally strong represented. So let's have a look at the hourly chart. Here we're seeing a strong flow of higher highs and higher lows. Good, that is a confirmation of the bullishness. Let's have a look at the MACD. That is also pointing higher. Very cool. Are we getting any bearish signals from the stochastic? Not quite, but we see that maybe we are topping out a little bit. So we could push higher a little bit more at the start of this week before finding resistance, and then we really need to see, once again, scenario 1, scenario 2 is not a strong preference, because there is an okay chance for this whole thing to continue higher. Zooming out, can you see we have been within this ascending channel for quite some time on the hourly chart that has been guiding price, and here the resistance, the big resistance, is at 86. These are the highlights for the week ahead. I hope you found this useful. Do make sure that you complete the pre-sign up for the Hybrid Traders Playbook, where I'll show you how to combine technical with fundamental analysis. We will release this in January. Everyone, have a good start into the week. See you around, and bye bye.